Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon, 9, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, something bigger is happening with XRP right now. Not just in price, beneath the surface. And most people still don't see it. Because while attention stays locked on volatility, headlines, and daily noise, something more important is unfolding in the background. Infrastructure is being built. Institutions are positioning. And the gap between what XRP is today and what it could become may be wider than most people and investors realize. So the real question is not whether the market is emotional right now. The real question is, are you watching the price or are you watching the shift? Let's zoom out for a second. Because to understand what may be happening at XRP right now, you cannot start with the chart alone. You have to start with the system. The global financial system is under pressure. The trust between nations is weakening. Geopolitical tension is rising. And the old way money moves across borders is starting to look slower, more fragile, and more outdated by the day. Now that matters because when systems begin to strain, markets usually focus on the surface first. Price reacts, sentiment swings, fear takes over. But the deeper shift happens underneath all of that. And this is where it gets interesting. What if the real story about XRP has less to do with short-term price action and more to do with the kind of infrastructure the next financial era may actually need? Because if that is true, then a lot of people are looking in the wrong direction. And that is exactly why this moment matters. I just want to stop and take the time to thank everybody that takes the time to like, comment, subscribe, and share. These few things really do help the channel and grows and get this information to people who need to see this. That being said, let's dissect today's content, and I hope you enjoy. The problem with today's system. Think about how money moves today. Cross-border payments take days, go through multiple intermediaries, carry high fees, depend on trust. That system worked in a stable world. But today, it's starting to show cracks. And where systems show cracks, innovation doesn't slow down. It accelerates. We've seen this before. 2008 financial crisis. Markets collapsed. Fear everywhere. But what happened next? The companies build real infrastructure didn't disappear. They expanded. Amazon, Apple, Google. They didn't just survive. They dominated the next decade. Why? Because everyone focused on price. They focused on structure. And this is where it gets very interesting for XRP. Ripple's real strategy. Most people think Ripple is just another crypto company. It's not. Ripple has been building something much bigger. Not hype, not speculation, but infrastructure. Let's talk about something that shocked a lot of people. Ripple was responsible for minting around 20% of USDC at one point. That's not small, that's institutional scale, which means they weren't just participating in the system. They were helping run it. RLUSD, the missing piece. So why launch RLUSD? Simple. Control, efficiency, scale. Instead of relying on internal stable providers, Ripple is bringing their layer in-house, and this changes more than it looks. Because now you have XRP leads to settlement layer. RLUSD leads to stability layer. That's not just a product, that's a system. But here's the twist most people missed. What whales are doing. While retail is panicking, whales are accumulating. Consistently, quietly, strategically. This is not random behavior. This is pattern recognition. Smart money understands. Price is emotional. Structure is logical. And right now, those two are completely disconnected. Let's talk about market misinterpretation. The market is selling off, but that doesn't mean the thesis is broken. In fact, in many cases, it means the opposite. Short-term noise, long-term structure. Say it again, price is reacting. The system is evolving. Here's hype versus real value. Let's compare. Look at what happened with Solana, DEX activity. Massive volume spike, then collapse. Why? because it was driven by meme coins, speculation, greater fool theory. That's not sustainability. That's momentum. Now compare that to Ripple. No hype cycles, no viral speculation, just consistent infrastructure building. And this is where the real opportunity starts to appear, ladies and gentlemen. The asymmetric opportunity. This is what experienced investors look for. They look for missed assets, mispriced assets, misunderstood narratives, structural growth not yet priced in. That's called asymmetric opportunity. And many believe XRP fits that profile. Not because of hype, but because of positioning. Let's look at global implications. Now layer in macro again. Geopolitical tensions increase. Trust decreases. Demand for neutral system rises. What does XRP offer? Neutral settlement, fast transactions, low cost, no reliance on one system. So ask yourself, if even a fraction of global payments move towards this model, what happens? Let's look at investor psychology. Now let's talk about you, because this is where most people lose. The market tests patience, discipline, and conviction. When price drops, retail panics, smart money positions. This cycle repeats over and over and over again. Because here's the real question, the big picture. Are you reacting to price or understanding the shift? Because something bigger is happening. Not loud, not obvious, but structural. Ripple is building. Institutions are watching. Whales are accumulating. And the system is slowly evolving underneath the surface. Let's look forward. Now, does that guarantee anything? No. Nothing is guaranteed. But history shows when infrastructure changes, everything built on top of it changes too. If you made it this far, you're already ahead of most people. But I want to hear from you. Do you think XRP is being underestimated right now, or is the market pricing it correctly? Drop your thoughts below. And if you're part of the wolf pack, you already know we don't chase noise, we study structure. Make sure you like the video, subscribe, and stay locked in, because we're not just watching the market, we're watching the system evolve, always. Well, I hope everyone's having a happy holiday, and happy Friday to everybody. What a world we're watching. I wouldn't even know where to begin. So to me, the most important thing is what some of the titans are talking about. Why I go over we're being the remora. And ladies and gentlemen, if you're new here, you get the ice, part of the Italian ice. I want to welcome all the new members of the Patreon, all the new members of the membership channel. And let's take a look when I say that we're the remora underneath the apex predator. Just remember, ladies and gentlemen, one good tips from the pits can more than easily pay for your yearly subscription. If you want to join over 470 active investors and traders, do join the Crypto Republic desk monthly, where we're showing people how they can take advantage of this. But right now, I want to talk about the CEO of BlackRock. He just gave the world two futures. Again, two futures. One leads to oil, $40. The other leads to global recession. There's nothing in between. Larry Fink, the CEO of BlackRock, he is exactly what he was talking about. Iran normalizes plus Hormuz reopens equals oil back to around $40. Iran remains a permanent threat equals oil at $150 for years. Oil at $150 for long equals global recession. The math is so brutal. If you look where Brent is today, it's over 110, 120. It's already 47% above pre-war levels. Ras Lafarne's 2 to 4 years to rebuild. Hormuz blocking even Chinese ships. Saudi backup pipeline already maxed out. We're not even near $40. We're moving towards $150. Let that sink in. People are getting cut up like sushi. Tweets are moving the markets. Today's news, there was some planes shot down. You know, it's crazy what's happening. The man managing 10 trillion just said what he thinks may happen after that. It's so crazy. So if you look at right now, WTI is more expensive than Brent. The oil market is just broke its own rules. Again, this is so massive. So what we're seeing is WTI trading above Brent by 2. First time this happened during a global supply shock. Normally, Brent trades at a premium because it reflects seaborne global crude. Why this is happening? This is not about quality. This is about timing and scarcity. Right now, WTI equals May contract near-term barrels. Brent equals June contract later barrels. We're not comparing the same oil, ladies and gentlemen. We are comparing now versus next month. The bigger signal is extreme backwardation. Prompt WTI spread is greater than 16 BBL. That's a record. In my entire career on the floor of the Mercantile Exchange, and even now, I've never seen that. That's so massive that this is going to lead to so many opportunities downstream. It's insane, really. So near-term barrels leads to massively bidded up. Future barrels are leading to discounted. The market message is so clear. I need oil now, not later. So why is WTI getting the premium? U.S. barrels are available now, not trapped in Hormuz chaos. Inventories are drawing fast, leading to export pull replacing Gulf supply. Logistics advantage equals crushing U.S. system. So it's cushioning that system while the rest of the system is getting crushed with accessible balance. The inversion is not structural, ladies and gentlemen, but it's extremely informative. It tells you a lot. First, physical supply is tight right now. Second, logistics are more important than benchmark hierarchy. Third, market is repricing time, not just oil. So near-term barrels are more valuable than future ones. And right now, the only barrels you can rely on getting fast are in the U.S. So if Hormuz disruption continues, backwardation stays extreme. Prompt barrels stay bid. Distortions like this persist. Is this just a timing anomaly or the start of a new pricing world? I want to hear from you. Ladies and gentlemen, I'm trying to take the PhD out of PhD, but do you understand what that really means for oil and the world? First off, why I say we're the remora? Again, we're swimming underneath the apex predators. So we have to pay attention to what they talk about and why. This is so important. It really, really is, because when certain people speak who control a lot of money, it's very, very important. That's why everything in between are the alpha opportunities. Again, so we look at all these things and we're writing it down because it's affecting everything. Oil right now will make or break. If oil drops down, there will be such a rip your face off rally that will begin. But again, no one's pricing in the destruction that's already happened. That destruction's massive. But I want to throw some other factoids out here, and I hope you're writing these things down, because this is where we take the PhD out of PhD, and this is what I learned before the Mercantile Exchange. This is actionable intelligence, 100%, 100%. Because when we understand the recce of what we did, and these are notes from my own recce about what's happening and why. And now I'm going to take a look at coal right now in China, because when we put these on our boards of how we're looking for situations to take advantage, a lot of these transfer into the tips and the pits. This is how you do it. So 80 gigawatts of new coal in 1 year. China didn't bet on climate. It bet on control. Let that sink in. Write that down. It bet on control. While the world debated emissions, China built energy. The number, 80 GW of new coal capacity in 2025, highest build in 18 years, equivalent to 80 large power plants. That's strategic scale. Ladies and gentlemen, I told you that the entire AI battle is a kilowatts battle. I said that we can win because we can put our centers above nat gas areas, shale. Again, we know people are doing projects like that out in Alberta. They're smart, listening again. They're eating our lunch. Again, this is strategic. Pay attention. Hormuz leads to disruptions. Oil leads to 110 plus spike. LNG leads to constraint. Gulf supply leads to millions of barrels offline. Ladies and gentlemen, China learned from the Europe to Russian gas shock. Japan post-Fukushima crisis. Middle East repeated oil spikes and decided to keep building what cannot be blocked. So massive, it's right in front of everyone's face. Why coal wins in a crisis for China? Domestic, scalable, transportable by land, immune to naval choke points. The West saw solar, wind, net zero targets. China built a parallel system. Green on the surface, coal underneath. The transition narrative says that clean energy is the future. The reality says clearly energy security comes first. Look what's happening right now. Ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research and learn how to take advantage of all of this, come and join over 470 active traders, investors in the Patreon, the Crypto Republic Desk monthly community. And welcome to all the new members, because taking advantage of what I just said, it's one thing to react. It's another thing to be positioning. We position to take advantage of what I just said. It is a map to making alpha in trades. But I want you to listen up right now because I'm about to lay out isn't some polite market commentary. Okay, this is a full-throated warning from the trenches of institutional money management. None of this is advice, just my opinion. I've been deep in the data through every cycle, and right now, we're in a regime shift that most retail investors are sleepwalking through. Wake up. You gotta wake up. This isn't the easy money decade anymore. This is the wartime allocation of capital. Global conflicts, especially the escalating tensions centered in Iran and those critical maritime choke points like the Strait of Hormuz, have locked us into an elevated stress regime for years. It's not temporary, it's structural. Policymakers are smart, money aren't chasing growth narratives or AI hypes anymore. They're prioritizing security of supply, scarcity pricing, and ownership of real tangible assets that can't be printed or digital away. You realize that they're telling people in Australia to take the bus? Ladies and gentlemen, they're rationing energy in countries. Southeast Asia is dependent on a lot of oil from the Strait. They don't get it, they got issues. This is going to lead to situations that people can't even fathom. And the markets, they're reflecting exactly that. Headline indices look stagnant, flat for extended stretches. Groundhog Day over and over with these fake breakout attempts that fizzle. But beneath the surface, pure chaos. Massive sectorial disparity. Single stock bloodbaths in some names, while others quietly print money. That's where the real alpha and the real pain has been concentrated. Hedge funds and multi-strat vehicles, they've taken meaningful drawdowns from all that high turnover gambling. But disciplined, long-only strategic anchored in real assets, way lower stress. Their performance gap is widening, and it's not closing anytime soon. Let's talk inflation, the dominant macro force that's still choking everything. Oil prices have settled into this stubborn corridor, high enough to keep cost pressures rippling through every supply chain, but not high enough yet to trigger real demand destruction that world let central banks declare victory. This isn't going away. The base case, pulled straight from the latest fundamentals, price action, positioning data, and macro signals, is that this inflationary corridor persists through the rest of this year and well into 2027. Unless we see a decisive supply response, which looks unlikely given the current incentive structures, unfortunately, ladies and gentlemen, rising yields are acting like gravity on risk assets. They're compressing equity multiples, eroding real returns on financial paper, sustained rallies in broad equities. Forget it. Not without clear cooling and energy costs. And right now, the energy complex is at the epicenter of the entire mess. Efforts to suppress oil prices have completely backfired. They backfired. They've discouraged the very supply response we needed. U.S. rig counts have remained stubbornly unresponsive, even at prices that historically would have triggered a drilling boom. Supply is inelastic. Remember that. Write that down. That locks us into the inflationary corridor with persistent upside risk. Look at the data screaming at us. Global oil in transit has contracted sharply. Tens of billions of dollars and floating supply removed from circulation. So, ladies and gentlemen, on paper, inventories might look okay, but the pipeline feeding them is thinning fast. Emergency reliefs of hundreds of millions of barrels. They've been burned through without fixing the tightness. So if you look at OPEC production, down to multi-year lows. And the futures curve, it's in record backwardation. The premium for immediate delivery over the next month is as extreme as we've ever seen. At least in my career, I've never seen this before. It's crazy. This is the critical point. Most people are underweighting 100%. The full cost ripple hasn't hit yet. Higher diesel, elevated shipping rates, increased power generation expenses, renewed inflation pressure across consumer goods and industrial inputs. When it does, and if it will, transit bottlenecks persist. The narrative flips from energy event to broad cost shock. Corporate margins get crushed. Consumer spending power evaporates. Earnings outlooks for any sector relying on cheap energy, toast, sushi. Yeah! Tactical forecasts, oil tests fresh highs in the coming quarters. That lifts the entire commodity complex and accelerates the real asset rotation we've already seen underway. The rotation is secular, folks. Early to middle innings of generational repricing of scarcity. Capital is fleeing high multiple speculative tech names that thrived in the old rate abundant liquidity world. It's pouring into the real economy, industrial metals, energy, transportation, anything tied to physical production and global trade, rising manufacturers' PMIs worldwide despite the geopolitical noise are reinforcing it. Investors are finally willing to pay for assets that deliver genuine economic utility, not promise future cash flows that may never materialize under high for longer costs. If portfolios still overweight, the old bubble economy exposures, structural headwinds are there, and they're ahead, unfortunately. They're tilted toward real assets without pricing power. So you're positioned to benefit from sustained inflation pass-through. Market positioning tells the story too. Commodity trading advisors and systematic strategies have deleveraged aggressively, stripping directional bets, layering on hedges at scale. The market is already heavily insured against downside. The market's fresh shorts or long views dangerously. It triggers squeezes instead of smooth moves. Implied volatility sits elevated versus realized. Skewed is pronounced. Option expiry flows from retail dip buyers add this predictable but distorting the layer. The result, repetitive technical rhymes instead of clear fundamental moves. So what you're looking at, credit markets are flashing red flags. Consistent with all this, high yield, loan distress is rising. Credit spreads are widening. Financial conditions are tightening under the surface. Calm corporate balance sheets levered up after years of cheap borrowing now face higher refinancing costs plus input inflation. In the stress case scenario, this culminates in selective defaults that force policymakers into moves once considered unthinkable. Quiet discussions about coupon adjustments on Treasury securities, basically debt relief, have trajectoried in certain circles. So if this happens, violent reaction, dollar depreciation, gold and hard assets surge, sovereign risk premium repriced across developed markets. Low probability in the immediate term. But the fact we even contemplating shows how unsustainable fiscal burdens have become under current growth and inflation. That's why nominal fixed income looks vulnerable and inflation-linked instruments plus real assets that actually preserve purchasing power stand out. So if you look at against, how do you juxtapose against these headwinds? The one secular tailwind that's real, artificial intelligence and decentralized compute infrastructure. Demand for GPUs and specialized hardware has exploded. Massive capital commitments into data centers, power generation, supply chains. This trend is structural, not dependent on zero rates, but near-term risks are elevated. Higher financing costs, geopolitical threats to component chains and energy prices, hammering operating expenses for hyperscale. The highest conviction approach here is selective exposure only to the highest quality names in the AI stack, those with pricing power, contracted revenue, and fortress balance sheets, while steering clear of the more speculative or capital-intense plays. Transformative potential is undeniable. Ladies and gentlemen, it's undeniable, but it must be balanced against the broader macro tightening that could delay widespread adoption. So political and social factors, you're asking? They compound everything. Leadership, approval ratings low, communication around crises, including these Iran developments, lacking cohesion. That raises the odds of policy missteps, delayed inflation responses, and episode social unrest disturbing labor and supply chains. Markets have numbed to headline noise, but erosion of public trust make it harder for authorities to anchor expectations or engineer soft landing. You got to let this sink in. This is so huge. They ignore the political theater. They focus on hard data, energy flows, manufacturing surveys, credit metrics, positioning flows. They will dictate outcomes far more than any speech or election or any tweet. It's so important. You're going to have to rewind this and write this down. I can't believe we're giving you this for free. This is free. You write this down. You see what wins. Here's the new systematic risk almost no one talks about. And none of this is financial advice, just my own opinion. Again, the homogenic of qualitative and algorithmic strategies. When models converge on the same signals, tiny correlations. So when models converge on the same signals, tiny correlation breaks cascade into volatility spikes. Traditional 60-40 broken. Bonds no longer diversify into inflation is the driver. So investors have rotated into equities and real assets anyway, despite higher headline risk. This regime demands fresh risk management. Modest long volatility. Insurance makes sense as a structural holding, not for speculation, but as protection against fat tail events that this hedged deleveraged market is primed to produce. Synthesizing it all, the 12 to 18-month forecast is crystal clear. Persistent inflationary pressure in the 3 to 5% range, higher in energy-sensitive pockets, elevated beyond yield-capping equity models, continued rotation to real economy sectors, and episodic volatility. Spikes driven more by technical positioning than fresh fundamentals. Risk assets will struggle for consistent positive returns without real progress on any normalization. Gold and hard commodities, they should do very well as stores of value amid dollar weakness and policy experimentation. AI infrastructure stays a core theme, but only with careful stock selection and sizing. Overall portfolio construction should prioritize capital preservation. inflation protection, and liquidity for opportunistic buys during dislocations. Reduce exposure to rate-sensitive growth names. Increase allocation to energy and materials producers with real pricing power. Maintain or add volatility hedges where it fits. Not financial advice, just my opinion, and anyone retains any capacity. This environment is challenging, but it's also one in disciplined, fundamentals-driven investors have historically generated outsized results by avoiding crowded trades and owning durable sources of value. Don't chase beta. Own scarcity. Manage risk aggressively. Geopolitical headlines will keep swinging price, but they don't change the trajectory. Inflation, persistence, and capital flowing towards non-printable resources. Nuclear or fission breakthroughs, multi-year away until own the asset that benefit from scarcity pricing. Again, so until then, own the assets that benefit from scarcity pricing. That's one of the greatest things that we think right now is so important. Again, this isn't doom and gloom. It's clarity. The game has changed. Adapt or get left behind. Hit like if this woke you up, ladies and gentlemen. Stay disciplined. Stay asset real focused. We're navigating this together. Ladies and gentlemen, what this means for you. Most people will wake up after this. It's obvious. By then, positioning is already done. Inside here, we're not reacting. We're tracking it early. We're breaking it down, simplifying, and we're positioning ahead of the narrative. And this kind of breakdown helps you see the market clearer. The deeper tips from the pits drops go even further into where capital is actually moving, how to position ahead of these shifts, what signals matter, and what is just noise. Ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research to learn how to take advantage of all this, come and join the over 475 active traders investors in the Patreon, the Crypto Republic Desk Monthly. Ladies and gentlemen, this is what's happening right now. The ability, and remember, this content is for informational entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Ladies and gentlemen, I want you to understand something right now. I go through a lot of information very fast. I rattle it off. We try to get on the phones. We try to get off the phones, unfortunately, to get to you as fast as we can. The difference is the whole world is rearranging right now. We believe downside pressure is coming. And if you made it to the very, very end, I salute you. Downside pressure is coming. Because if this goes kinetic and troops are inserted on the ground, there will be a sell-off, in our opinion. And that will, as far as we're concerned, lead to one of the last really bottom fishing events that can really be pushed down lower. A lot of people are going to get cut up like sushi. But at the end of the day, I learned on the floor, God doesn't give you what you want. He gives you what you need, and the rest is up to you. That was preached to me by one of my biggest mentor traders on the floor. He preached it. I can hear it every day still. Because the markets, they don't give you what you want. They give you what you need. The rest is up to you. Same way we make a living by what we make, a life what we give to others. The market is giving us a lot of chances to take advantage of plays right now. Because believe me, entire industries are being built on the reshuffling of the board. The reshuffling of the board. Why get left behind? I don't expect most people to understand what I'm saying, but I want you to understand this. I gave you my Gucci clarity, my Gucci conviction. And if you're at the end of this video, give me a thumbs up. I'll know you're here because I'm about to give you my rant. And this is it. Ladies and gentlemen, you can complain about price action all you want. Nobody's coming to save you. And this goes out to everybody. And I love chatting with everybody in the Patreon. I do love hearing everyone's story. For everybody who I speak with, who had to go to work and learn an occupation that they knew nothing about, and they were the first generation in their family to actually pull their family out of poverty, I salute you because you did the 15-hour days of work nobody else would do. You learned something you knew nothing about, and you took a risk, and it worked out for you. So the greatest risk now is doing nothing because the world is changing. Our dollar's losing value. Our gasoline is more expensive. Our assets are going down in value. You have to get clarity here, the Gucci conviction. You must let anything that vexes your mind of thought thrown out because Rome was not built in a day, but they were laying bricks every night. You will come back to this situation, this time period, when this is over. Again, because this time period will end. This conflict will end. The damage will be assessed. They will put things into place because people have an agenda to want to win elections. So they're going to influence markets, in our opinion, not financial advice, one way or another. Again, it's like harnessing the wind in a sailboat. Why would you try to sail into the winds? Let it push you in the right direction, because these are upsetting times we live in. But that's what the storm of life is about. Everybody who's always talking about learn how to trade, learn how to do this. The biggest thing in trading is your mind, is your patience. You're rewarded for your patience so you don't get cut up like sushi. If you're impatient, the market gobbles you up. The market doesn't care that if I make a video that it goes down. If you don't like my videos, you don't have to watch. I love you anyway. If you want to comment with your haterade, I love you anyway. I love you all. But don't let what happens now shake you out. Don't throw away all the hard work you did to accumulate the positions that you got in this space. Again, see it from where we see it. That satellite perspective, that Gucci clarity. You got to get that Gucci clarity or you're going to get cut up like sushi. Again, the crypto world is coming. XRP, ICP, HBAR, XLM. These ones are massive. They are. You just got to know to have the conviction to hold on to it. But ladies and gentlemen, I love you. Have a happy holiday. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You got two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves it'll never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay focused, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button. Ring that bell and leave a comment with your thoughts. Turn on notifications and, most importantly, subscribe to Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic. Not financial advice, my opinion. I love you all. Stay safe, everybody.